Good morning everyone and welcome to this weekly macro and strategy update. This week I would like to discuss gold price and its role in our asset allocation. I will also try to explain the divergence between gold and Bitcoin prices. Last week, precious metals continued their downtrend. Since gold reached an all-time high in August this year, its price fell 14%. In November alone, gold price fell 5% and crossed its 200-day moving average, which is a technical indicator that determines long-term market trends. This trend is explained by investors' optimism over the coronavirus vaccines and by the overall positive sentiment about a more stable political environment. After all, gold is a non-productive and a psychological asset which tends to underperform when markets rally. However, the conditions that drove gold to an all-time high this summer are still in place and are likely to be here next year too. A weaker dollar, rising inflation, low yields, and market volatility. In November, we increased our allocation to equities and the cyclicality of this asset class in our portfolios, but we need to continue managing the level of risk. Gold is a store of value in times of crisis, and we are certainly still in such a time. For example, it is still unclear how long the vaccines provide immunity, how we are going to get out of this crisis, and with which level of debt. Gold is still up 18% this year, and we keep our exposure, expecting a rebound after this consolidation. As to the Bitcoin, the current rally is explained by PayPal's launch of a new service enabling Bitcoin as a funding source to its network. Similar solutions offered by other financial companies have increased demand by retail investors. Bitcoin also comes more and more into the radar of sophisticated investors that include it in their asset allocation, along with positive assessments by brokers. In our view, this uptrend is more technical than fundamental, and this cryptocurrency is still much too volatile. Thank you for listening and see you next week.